Hello, this is Dan Betzel, and I want to welcome you to our next investor workshop. The title of this workshop is The Investment Vortex, Getting Through the Black Hole of Investing. And this workshop is actually dealing with a very, very important question. How do you know if your portfolio is performing within acceptable parameters? Or in other words, how do you know if your portfolio is working as designed? I often ask clients this question, and the response they give me is understandable, is very understandable, and sometimes a little humorous. They'll say, "Well, I open up my statement, and if the account has gone up, it's working. If the account has gone down, it's not working." And I understand that from an emotional perspective, but nevertheless, that really is not the best way in order for you to determine whether or not your portfolio is working as designed. I'll give you an example from, I'm sure we've all have gone to the top of a tall building in New York or in Chicago, and when you're at the top of that building, it's swaying a little bit. Now, the fact that that building is swaying a little bit doesn't mean that there's anything wrong. As a matter of fact, it's swaying, hopefully, within the parameters that the architects and the engineers have designed for that building in order to make it structurally safe. It's very similar when you're flying in an airplane. If you've ever sat by the window and looked at the wings, you can see that during flight, the wings will often vibrate or move up and down. And they have to move up and down. They're designed to move up and down in order so they don't break off. But how does that apply to your portfolios? And how much sway or how much volatility or how much up and down should there be in your portfolio? And we're going to discuss that. And we're going to look at that and look at some hypothetical um, portfolios and look at what would be anticipated or expected um, rates of return and amount of risk inside of that portfolio for the return that the client is expecting. So there's been some really interesting studies. We've talked about this Dalbar study before, that the average equity investor um, earned a relatively low 3.69 return from 1984 to 2013. That's a 30-year period. And if we look at the exact same period, 1984 to 2013, the S&P 500, which is just one asset class, but nevertheless the S&P 500 averaged 11.1 percent for the same period. So we have to ask ourselves, why is it that the average investor only received 3.69% when the S&P 500 averaged much greater returns for the same period? And I think it has to do in large part, or at least in significant part, to investor behavior. Investor behavior can often contribute to poor results in the investor's account. So, what does the investor do that undermines long term results inside of a portfolio? So, for example, the average investor inadvertently chases hot asset categories. So, sometimes the investor's doing that without even really realizing it. For example, when tech stocks are hot, when growth stocks are hot, or when stocks lose 30% while fixed income is gaining 4%, they'll switch to the hottest category relative to the others. And by so doing, they're inadvertently chasing the hot asset categories, which, as we'll see here shortly, means that they are doing the opposite of what prudent investing would dictate. They are actually um, buying high and selling low. Another investor behavior that can contribute to poor results is inadvertently forsaking true asset class diversification. Now, we've all heard day traders talk about how they chase the winners and dump the losers. And if you're always buying stocks or funds when they're high and selling the assets when they're low, well, guess what? You can actually unintentionally, inadvertently undermine your diversification strategy because you'll have no dissimilar price movement. Everything's doing the same thing at the same time, and your entire portfolio often will end up with only a handful of asset categories. And that's often what happens. And another investor behavior that contributes to poor results is the average investor will often panic and take money out of the stock market and forsake equities when the equity markets are bad. And why does an investor do that? Well, during these times, we are bombarded with magazine articles and business commentaries and other news media hype which predict that the equities market is on the downside and may not recover. And investors often rush to place their money in fixed income asset categories, and thereby again they're selling their equity positions low, and they're locking themselves into fixed income. And then when the equity markets do recover, they don't participate in that recovery because they come too late to the party, so to speak. Um, so what this means is often the average investor will sell asset categories that are low, as we've said, and buy asset categories that are high. So why do investors underperform the market? Well, without a financial advisor or financial coach, the vast majority of investors may shoot themselves in the foot because they lack the knowledge to set realistic investment expectations and the discipline to maintain a strategy over the long term. And it's my hope that in this workshop that when we reach the end, that you will have the knowledge and you will understand the amount of risk in your portfolio that you're taking for an an expected or possible rate of return, and that knowledge will then give you the discipline to maintain that strategy and to understand that how your portfolio is working, even though it may not, even though you may be opening up the statement that particular month and it won't be up from the last statement. We're going to look at that, and that's my goal, and hopefully you'll find it helpful and not just helpful on a cognitive level, but that it will also give you the requisite knowledge to make good investor behavioral choices. So let's review the basic principles of investing. So own equities and fixed income assets, and you have to own them in the proportion that reflects your personal risk tolerance and designed for your time horizon, or for other words, how long you have to 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 um, to allow your money to grow or allow your money to be in the market. You have to diversify among equity asset categories, and we have to periodically rebalance your portfolio to maintain expected risk reward profile rather than chase performance, and to keep your portfolio on the efficient frontier. So what this means really is overall remain disciplined for an entire lifetime, and that's very difficult for all of us. Again, the concepts are easy to understand intellectually, but they're often very difficult to put into action and to apply because of the emotional aspects of investing and the media and what we are bombarded with through the financial planning media, magazines, TV, radio. It's everywhere around us. So let's begin to look at this, what I call the black hole of investing. Now we're going to look at some tables and graphs, and I'm going to try to make it as clear as possible, although whenever you're working with tables and graphs, there is the possibility that you could just zone out and when you're looking at the graphs and the numbers. So I'm going to try to direct you to what's the bottom line in each of these graphs and summarize it before we move on to the next one. But the tables and graphs that follow are an illustration of the relationship between risk, return, and expectations. And they demonstrate how these factors can affect an investor's portfolio over time. Now, this information is not intended to and does not show the results of actual trading. These are hypothetical portfolios, and we're using back testing, and the returns are not indicative of Matson Money's skill in managing client accounts. So please don't infer that your assets would have had the same performance results if Matson Money managed your assets for any part of the referenced periods. But nevertheless, even with these limitations of the analysis, and there are always inherent limitations in any type of analysis that you do, I still think you're going to find the information, at least potentially, very useful in helping you understand risk and return and expectations. So let's begin by looking at table number 1. Now, we've created 4 hypothetical asset allocation portfolios, and each asset allocation portfolio has a distinctly different risk return objective. And although that may sound like a mouthful. Basically, what we're saying is that you, as an investor, you need to understand where your portfolio is on this particular spectrum of conservative, moderate, growth, and aggressive. And and inside each of these hypothetical portfolios, we're going to explore the distinct risk return objectives and compare them to each other. So moving forward, you will know what to expect from both a risk and return objectives. Again, those are objectives. Now, as I said, that the upcoming charts and graphs, we use historical market data to create back-tested performance returns for each asset class as represented by the various market indices discussed. And there's a lot more information in the endnotes about this. And the goal is to help you demonstrate the potential benefits of diversification and to get a clearer grasp on risk return objectives that are inherent and that are to be expected within each portfolio. So if you look at this table number one, you'll see that there's a conservative, a moderate, a growth, and aggressive portfolio as we move from the left to the right-hand side of the screen. And what you'll notice is that there are basically three large groupings of asset classes with subdivisions under each of them. There's fixed income, there's U.S. equity, and there's international equity. Now, the conservative portfolio is going to be based on 75% fixed and then 25% spread over U.S. and international equity. A moderate, sometimes called a balanced portfolio, is going to be 50% in the fixed and 50% in the equity, international and U.S. equity. It's why it's balanced, 50%, 50%. A growth is moving us down to 25% of fixed and then 75% spread between, as you can see, U.S. equity, international equity, and then the aggressive is very aggressive with only 5% invested in the fixed income asset class and 95% spread among U.S. equity 50 and international equity 45. So you would probably, even at this early point of our discussion, it's probably somewhat intuitive that you would expect that a conservative portfolio would have less risk, less volatility, less up and down movement than an aggressive portfolio. And at the same time, you would also expect that a conservative portfolio is probably not going to have the same expected return objective. It's not going to grow as much as the aggressive portfolio. That's probably kind of an intuitive, I would think, feeling you may have. But as we move forward, we're going to back that up with some real interesting graphs that we're going to look at here. So this chart, this table is really giving us the same information but putting it in a pie chart form as opposed to a numerical table form. And I think it's pretty helpful to look at that. And these pie charts illustrate the percentage of fixed income, U.S. equity, and international equity in each of the four sample portfolios that we just talked about in table number one. Now next, we're going to discuss the estimated levels of volatility of risk of up and down and return that investors could have experienced for each of the four sample portfolios over a 20-year period of time. Now again, before we move on, let me reiterate that these are back-tested hypothetical performance returns, and they're based on historical market data from various representative market indices for each asset class. And as I said, back-tested performance returns have inherent limitations and should not be considered to be indicative of future results. In particular, it does not reflect the performance of actual accounts, and there's no guarantee that an actual account would have achieved the same results. But nevertheless, I think you'll find the information helpful in getting a clearer grasp of what I would call differentiated risk and return objectives of various portfolios. And like I said, endnote number one of this presentation is going to talk more about back-tested performance and some of the limitations that I've expressed to you here for using that information. So let's begin by looking at the hypothetical conservative mix. Now, you may recall that the conservative mix consisted of 75% fixed and 25% equities spread out over the US and international equities. Now, what you'll see on this particular graph number 1 is you're going to see an averaged annualized rate of return of 6.68 net of 2% fee. Now, above the average annualized rate, above that pink line, you're going to see a purple line. And it says, if you look at the box in the upper right-hand corner of the graph, it's the upper 95% confidence level. And then if you look in the blue box part of the graph, you're going to see a yellow or orange looking line, and it's the lower confidence level, 95%. So what does that 95% mean? That 95% confidence level is very important. It's simply put, it's showing us the highest and lowest potential returns during a specific time period. Now, why we say 95% is whenever we do any type of statistical analysis, there's always the possibility that a given rate of return could fall outside of this upper and lower 95% confidence level. So let's look at this. A couple things we can notice that, of course, the average annualized rate of return is exactly that. It's an average. That at any given point, you're with 95% confidence level, a portfolio could be functioning anywhere between those upper and lower confidence levels. So how do we know if a portfolio is working? What if you put money into the account and you open it up and the account is down? Well, if it's down 3 or 4%, you can see from this graph that it's still actually functioning between the upper and lower confidence levels. Now, if you look at the graph, the reason we're called the vortex or the tunnel is you can see that as you enter the graph from the left-hand side, you're entering the vortex, the tunnel, and over time, the upper and lower confidence levels begin to converge, begin to come together. And you'll also notice that it's somewhere around year 6, the lower confidence level actually breaks even or comes above 0. Well, let's look at this exact same chart, but not looking at it as a graph, but looking at it here with some numbers on it. So here's the key points. Investors are just as likely to perform above the 6.68 average as they are to receive rates of return that are below it. And the lines on either side of the simulated annualized rate of return demonstrate the range of simulated annualized rates of return using this confidence level of 95%. The break-even point, as we talked about, where the lower confidence level crosses 0, is at approximately 6 years. So here is the real lesson that we can take from this. Let me back up here for a second, go back to the hypothetical conservative mix. So the goal is to stay disciplined, right? Because if you stay disciplined, then we can see that the variability of the annualized rate of return, or in other words, that fluctuation between the upper and lower confidence level, it dramatically drops over a 20-year period, and the lines begin to converge. Looking at the same thing again, we can see from the hypothetical conservative mix that if we remain disciplined and the portfolio was designed properly for us initially, and we remain disciplined over the 20-year period, then we're looking at, with a 95% confidence level, a low of 2.71 and a high of 10.65. It's very interesting. Now let's take this information and compare it to the next hypothetical portfolio mix that we talked about. That would be the moderate mix. Now you may remember that the moderate mix consists of 50% in the fixed and 50% spread over the international and the US equity markets. So just by comparing vortexes for the different hypothetical mixes, I think and I hope my goal is that it'll provide a useful way to better understand the relationship between risk, volatility, and return. So this second graph shows the vortex of annualized rates of return for the hypothetical moderate portfolio held for each rolling period from 1 to 20 years from 1973 to 2013, just as we did for the hypothetical conservative portfolio graph a couple slides earlier. And again, we're using the 95% confidence limits for the annualized rates of return. So as might be expected, right? As you would expect, the simulated back-tested rate of return for the moderate portfolio, it's significantly higher than the conservative portfolio. Why is that? Well, it's largely because the moderate portfolio mix includes more equity exposure. Remember, it's 50% equities and 50% fixed. So if we're looking at this, the average annualized rate of return is 8.32. So notice again, however, that just like the conservative portfolio, over longer periods of time, some of the risk seems to get sucked out of the portfolio. For example, if we go to a 5-year period of time, the simulated low was, if you look at 5 years here, was, and I'll show you a graph or a picture of this in a second, was negative 1.24% and the high was 17.88. So as long as your portfolio was between these two goalposts, well within the vortex, you could know it's performing as it was designed to perform. As I said before, note that on rare occasions the portfolio could hypothetically perform outside of the boundaries. It's rare, but it can still happen. So over longer periods of time, what happens? Well, the vortex has continued to close around the average. And so here's the real point. It takes time, and we have to understand the risk inside of our portfolio. We have to understand how the portfolio was designed so that we can withstand the things that are going to occur, right? Things that we're going to experience. We don't know when or how, but it's almost sure that over a long period of time, there's going to be events. For example, recessions, God forbid, terrorist attacks, business scandals, and other events that are going to disturb and rattle the markets. But the good news is that the markets have persevered over time and preserved over time. And the question is, we have to use this knowledge to help us be disciplined and to help us understand what's going inside of our portfolio and not succumb to fear and to other market forces. Again, it's crucially important, I believe, that your portfolio was not only designed properly at the beginning, but that it reflects your personal risk tolerance and your personal investment goals, but also that you understand how it was designed, and that you understand that if it's functioning between these upper and lower confidence levels, then it is functioning as designed. Well, let's keep looking. These are the key points that I think I've already covered. Investors are just as likely to perform above the 8.32% average as they are to receive rates of return that are below it. And the break-even point, as I said, is about year 7. And once again, the message is that a prudently and broadly diversified portfolio, once it's designed, the most critical component to success is discipline. And only by maintaining discipline and avoiding the urge to concede to short-term market trends may investors begin the journey toward experiencing, long-term investment success. Let's now look at the growth portfolio. Now, you may recall that the growth portfolio consisted of only 25% in fixed income and 75% spread among the U.S. and the international equity markets. So, graph 3 is showing the vortex of simulated annualized rates of return for the growth portfolio. And we can see that the average annualized rate of return is 9.8% net of a 2% fee. So this graph is also demonstrating to us that the growth portfolio had a higher rate of return and more volatility than either the conservative or moderate portfolio due to its asset mix, which, as I said, as we talked about, has an even higher ratio of equities to fixed income securities. So the simulated returns for this hypothetical portfolio were 9.8, and the range for 1-year annual returns was, look at that, it could be as low as -20 to as high as 39.73. Yes, the upside looks great, but how do you feel about the downside? And if everybody wants that great rate of return, but with that comes also the potential for the downside. So now the break-even point here is it's interesting. It's about year somewhere after year 7. The break-even point for the conservative portfolio, if you remember, was earlier, and as we're getting to portfolios with more risk involved, it takes longer for us to achieve the break-even point. So let's go to the hypothetical growth mix chart here, and again the key points are, and you'll see that they're the same key points for each portfolio. Investors are just as likely to perform above the 9.8 average as they are to receive rates that are below it. The break-even point, the point at which the lower confidence level crosses 0 for the annualized rate of return, I believe I said earlier was 7. It's actually closer to 9 if you look here. It's happening closer to year 9. The variability of the annualized rate of return drops dramatically if you are able to remain disciplined and hold the particular portfolio for 20 years. So once again, the most critical component to success, assuming, of course, that the portfolio has been designed prudently and broadly diversified, is investor discipline. And by maintaining discipline and avoiding the urge to concede to short-term market trends, investors again begin to experience longer-term investment success. Well, let's look at one more hypothetical portfolio. This is our aggressive mix. Now, you may recall that the aggressive portfolio consisted of only 5% in the fixed asset category and 95% spread, 50% in U.S. equities and 45% in international equities. So we can observe the following from graph 4. Of course, it's kind of intuitive, I think, but the hypothetical aggressive portfolio had higher simulated rates of return and, important, higher volatility than any of the other 3 portfolios because it has the highest ratio of equities to fixed income. So you can see that in each of the rolling first-year periods, the simulated returns of the hypothetical aggressive portfolio had a rate of return roughly from negative 27% to a high of 49%. So let's go back to the hypothetical $100,000 investor. That would mean that he could have lost more than a quarter of all his wealth, meaning he now has less than $75,000, while just 1 year before it was worth $100,000. So you have to be aware of this before you invest in any portfolio, whether it's the conservative, the moderate, the growth, or the hypothetical. You have to be aware of the risk, of the 1 year downside risk, and be able to tolerate that, be able to live with that, because the destructive behavior would occur if someone were to invest in aggressive behavior, and then at the end of the first year, the portfolio is actually down 25 or more percent, and the person is not able to weather that storm, then goes to fixed equities, or to fixed income, excuse me. The market recovers, but of course the investor doesn't participate in that recovery because his money is sitting in cash or cash equivalents and locks in losses. So if you are an aggressive investor and your portfolio in 1 year, year 1, happens to be down 20-25%, well, it's still within the upper and lower confidence levels for 1 year, and that would mean that the portfolio is still functioning as designed. Now we can see what happens again after 20 years. You can see that the risk over time is being sucked out and the upper and lower confidence levels begin to converge. And after 20 years, the simulated annualized rate of return was more of in the range of 3, little over 3 to a high of 18%. So again, discipline is the crucial key. So what are the key points for this particular hypothetical aggressive mix? Well, investors are just as likely to perform above the 10.81 average as they are to receive rates of return that are below it. And so using the 95% confidence level, we know that the highest and lowest potential returns during the time periods covered are on are on that graph or represented on this chart. Now, so these limits form what I'm calling the vortex or the tunnel, and they begin to upper and lower confidence levels begin to converge and begin to come together over time. Now, the break-even point, the point at which the lower confidence level crosses zero for the annualized rate of return, is approximately 13 years. Now, that's much different than it was for the conservative, the moderate, or the growth portfolio. So not only do you have to be able to take additional risk volatility, you have to have also a longer time horizon if you're going to, as you begin to move from the conservative to the moderate to the growth to the aggressive portfolio. So again, the bottom line, once a prudently and broadly diversified portfolio is designed, the most critical component to success is discipline. And only by maintaining discipline and avoiding the urge to concede to short-term market trends may an investor begin the journey toward experiencing longer-term financial success in investing. Now, I think this is a fascinating slide. We're taking graphs 1 through 4 and we're superimposing them on top of each other. We're looking at the conservative, the moderate, the growth, and the aggressive portfolio. So by varying the asset mix in a portfolio, rates of return and volatility can be altered dramatically. So the longer a portfolio is held, the more likely, again, emphasis on likely, there's no guarantees, the more likely the investor will be to attain a compound annualized rate of return near the market return for the type of assets held in the portfolio that we've been talking about. Both of these points make it imperative for both the advisor and the investor to discuss what mix of assets is appropriate from a market return and volatility standpoint, and then to establish long-term goals. And that is absolutely crucial. And you need to understand as an investor, where your portfolio falls within the investment vortex here. So very fascinating. I find this and the next graph to be really didactic in the sense that I think there's a lot you can learn from it. You'll also notice that all of the portfolios begin to converge, and the lower confidence levels, actually almost converge into one line. Not exactly, of course, but it's still very interesting just when you look at it visually. So, graph 6, the risk of changing investment objectives. Now, we all know that things happen in life and that there's very, very wonderful things that happen that may change a person's investment objective. Maybe a business that you started does really, really well, and suddenly, the risk, you're able to take greater risks because you've accumulated a lot of assets and your business is pouring off a lot of income. On the other hand, maybe something's happened in your life and you were a moderate investor, but now you're either getting closer to retirement, or perhaps there's been an illness, or you've lost a spouse, and you need to be maybe perhaps more conservative. So I'm not saying that there aren't times when it's important that you reevaluate your investment horizon and your investment risk tolerance, and you make adjustments. But that's very different than changing investment objectives because you're trying to stock pick, market time, or chase hot asset classes. So why have we stressed that the most critical component and of the potential for success is the discipline to stay the course? Again, assuming that your portfolio is well designed and that it's truly asset diversified and efficient. But graph 6 illustrates the risk of changing your investment strategy frequently. Now, this is for illustrative purposes. So Vortex A represents a portfolio with a simulated annualized rate of return of 13% net of all fees. Mutual fund investor returns were prepared by Dalbar using data supplied by the Investment Company Institute and are represented by the change in total asset funds after excluding sales, redemptions, and exchanges, and capturing realized and unrealized gains. So the statistics of all of this and the numbers and how we came up with this, you're going to find in the endnotes. But I think it's still very interesting that, as we've seen in previous graphs, the longer a portfolio is held, the smaller the range of values for the annualized rate of return. But suppose an investor lacks discipline, and an investor keeps changing investment philosophies. So every 3 years, The investor decides that, you know what, this isn't working like I wanted it to. I want to change my investment objectives. I want to change my investment objectives. When an investor is doing that, they're re-entering the vortex time and time again, and they're not allowing time to work on their side to bring those upper and lower confidence levels together and to suck the risk out. So the average Dalbar investor, you can see the line here, is only receiving 3.69 uh, compared to the S&P 500 index with the return of 11.10. Now, if we take out the CPI, representing inflation, we take that from what the average Dalbar investor, equity fund investor is received, we subtract 2.8.3.69, and you can see that for all of that hard work and all of that saving and investing, they barely stayed in front of inflation. So this chart, I think, clearly indicates that Dalbar average equity investor returns have been significantly less than the leading equity market index. And a part of that can be explained through investor behavior and a client's changing investment strategies too frequently based not on substantial change of experiences in their life, or, circumstances in their life, but because of the desire to chase, sometimes inadvertently, hot asset classes, market time, and engage in stock picking and track record investing. So let's look at the 20 must answer questions, and I'm hoping that each of these workshops will help you gain a foothold or help you get a better understanding of how you can answer these 20 must answer questions, because life is often about knowing the right questions to ask. If you know the right questions to ask, then very often it's going to help you get the information that you need as you continue your journey toward investing peace of mind. Now, if you recall, each of these questions have to be answered with a firm yes or no, not a maybe. So if it is a maybe, if you're not sure, then the answer has to be no. Here we go. So have you discovered your true purpose for money? That which is more important than money itself. Now, we all know that it's just not enough to know that money is not the most important thing in life. To actually get a yes to this question, you have to be able to know what is most important to you, that which is more important than money, and that which is more important than everything else in life. What is that? You should be able to express it in a word or two words or a short sentence. If you can, write yes. If you can't, then please write no. Now, number two is pretty straightforward. Are you invested in the market? Meaning, do you have equity stocks, or do you at least have equity-based mutual funds? Most people can get a yes to this question because most people today have some money in the market, whether it's in a 401k or a pension plan or their personal investments. Now, do you know how markets work? I talk to investors all the time and they have money in the market, but then when it comes to understanding the underlying dynamics of how the market works, they really don't know. It can be very disconcerting to have a portion of your wealth invested in a way that you really don't understand. So, do you know how the markets work? Yes or no? Number four, have you defined your investment philosophy? We all know that whether it's religion, education, science, or history, your philosophy is imperative to making decisions that are right for you. As we discussed today, it's very important that you understand what is your philosophy and that you then take steps to make sure that your investment philosophy and is in alignment with what the practical things you are doing in your investment strategies. So once you're able to identify your investment philosophy, you're also able to design investment strategies supportive of your philosophy. So have you defined it? Do you know what it is? Can you express it? Number five, have you identified your risk tolerance? Now, have you thought about it cognitively, consciously, and made a decision of how much and what type of risk you want in your portfolio? Now, today we talked a lot about risk. Hopefully it was helpful. Or have you had more of a smorgasbord approach where one year this investment looks good, another year that one looked good, and over the years you just kind of haphazardly built a portfolio with risks you don't know or understand? Yes or no? Number six, Do you know how to measure diversification in your portfolio? Do you know how well or how poorly you're diversified? Question number 7. Do you consistently and predictably achieve market returns? Answering yes to this question requires some historical knowledge of the market and actual market rates of return. Now, there are benchmarks that you want to look at to build your portfolio because most people don't know what markets have done historically and they have no idea whether they've achieved market returns or underperformed. Statistically, the vast majority of investors underperform market rates of return. So, do you consistently and predictably achieve market returns? Yes or no? Question number 8. Have you measured the total amount of commissions and costs in your portfolio? Earlier, we talked about the fact that many people are unaware of the risk, and in addition to not being aware of the risk, they also are unaware of the true costs. That's something that's also very, very important and something that you want to make sure you have a handle on. If you do, yes. If not, no. Number 9. Do you know where you fall on the Markowitz efficient frontier? So Markowitz, and we discussed this in earlier workshops, he won a Nobel Prize in 1990, and he determined that you can actually identify portfolio volatility by looking at historic rates of return and asset correlation. You can then use modern statistics and analysis to create a portfolio that optimizes potential return for whatever level of risk you're willing to take on. To pursue successful investing, I think it's critical to know where you fall so you can measure your rate of return against the risks you're taking. And we talked about that in today's workshop from a little bit different angle. When it comes to building your investment portfolio, do you know exactly what you're doing and why? That's question number 10. Now, if you're not getting many questions right, don't feel bad. This is not a quiz in the traditional sense of trying to make you feel bad or give you a bad grade. Most people, when they take this quiz, are not able to answer more than just a couple questions. But the idea is to help you know what to focus on so you can get these questions answered for you and to move you down the line towards your journey for financial peace of mind. Number 11, are you working with a financial coach versus a financial planner? In other words, are you working with someone who shares your investment philosophy and is going to help you get the answers to these and other questions that you may have? Do you have a customized lifelong game plan to guide all of your investing and spending decisions? We're talking about a way of looking at everything that's valuable to you, your life goals, your assets, whatever it may be, and actually planning out what you want to do with your life and your money. And it's a very, very big question and not an easy one. And the goal is that when you come to your end of life, and when you come to the end of your life, you don't have regrets, and you've accomplished those things, and you've helped those people in those causes that are important to you. And it's a really great question to think about. Do you have an investment policy statement? Question number 13. If you don't know what one is, then you have to put no. Question number 14. Have you devised a clear-cut method for measuring the success or failure of your portfolio? Now today, we spent a lot of time talking about this question and showing you one way to look at how you could answer this. So what is your measurement tool to know if your portfolio is doing what it's supposed to do? Question 15. Do you fully understand the implications and applications of diversification in your portfolio? So we talked a little bit about that today as well by looking at the various graphs and the various hypothetical portfolios and as it related to the 95% confidence level for return and risk. Do you have a system to measure portfolio volatility? And question 17, are you aware of the costs associated with purchasing commission-based products? Again, there's nothing wrong, but as a consumer, you should be aware of those costs and you should know what they are. Question 18, if you've taken any of the other investor workshops, you should be able to answer this question easily. Do you know the 3 warning signs that you may be speculating with your money versus prudently investing it? So are you engaged in stock picking, in market timing or track record investing. Um, so it's very difficult for most people to know if they're investing prudently rather than speculating because they often have no way to distinguish between these. But hopefully at this point, you're beginning to be able to see how you can distinguish between prudent investing and speculation. Question number 19. Can you identify the cultural messages and personal mindsets about money that destroy your investing peace of mind? Often our individual mindsets and beliefs about money, they're not things that we developed as adults. Many come from our childhood, from ages of like 5 or even younger. And it's very fascinating to begin to explore these personal mindsets and to and then to determine whether or not that particular belief is empowering or disempowering you. But we'll go into more detail in a subsequent workshop. Question number 20, the last question. Are you ready to shift your personal experience of money and investing from scarcity mode to an abundance mode, where you can live your life rather than obsess about your assets? I have often seen that people suffering from portfolio losses, lack of diversification, and excess costs feel that they're in a state of scarcity. Not enough time, not enough money, not enough investing peace of mind, not enough clarity, not enough focus, not enough capability. It's very difficult then to remain disciplined in order to move forward into the future. Of all of these questions, I think that number 20 is probably the most important. So, if you can answer yes to that, then you're ready to take the next steps to create more abundance in your life. And so that brings us to the end. And I really want to thank you for taking the time to um, work through this very important workshop with me. And I hope now you have a better idea of the right questions to ask. And I also hope that you have a better understanding of how you can go about making the determination um, of whether your portfolio is working as designed, whether your portfolio is broken or whether it is actually functioning exactly as designed, based on our discussion today. And I think that um, there's a risk always, of course, associated with changing investment strategies, and frequent changes to your portfolio can lead to a black hole of investing. And my goal for you is to educate you so that you can make very, very good decisions and understand risk and what it means for you and your risk return requirements so you can choose an investment portfolio that's going to suit you for a lifetime. I think investing can be an amazing journey, and I want to wish you the best of luck in avoiding the black hole of investing and reaching you and your family's personal and financial goals.